Back, folks. I'm the Butcher of Wall Street. Got some serious issues going on with pump and dump by the name of BYND stock. Is it actually a pump and dump, or is it actually a short squeeze? That is something that we're going to discuss because it seems really important. A lot of people are going long, a lot of people are going short, and there's potential opportunity there. Wall Street, but at the same time, some people are getting wrecked. So we definitely need to talk about BYND stock. Before we do, though, look at what Secretary Scott Bessent, Secretary of the Treasury, is saying about gold right now. The rising gold price has helped us substantially, he says. What do you think this means for the price of gold going forward? What we've seen today in silver, gold, and precious metals markets is nothing more than a correction. What's going on, Brian, Giles, Cody? Ladies and gentlemen, welcome back. Stocking.
Gold also has other applications, a lot of applications, jewelry in India, but it's something that historically people have all agreed on. And gold can't have a fiscal problem. Gold cannot have a gigantic budget deficit. Gold cannot have a war. So just the fact that it is this isolated thing makes it very interesting. And the fact that the entire global trading system, until Richard Nixon took us off, was tied to gold.
So you're not anti-gold?
Oh, no. When I had my fund, I think people might have called me a gold bug.
So you're not anti-gold. Oh, no. He is a gold bug, folks. What we're seeing today with silver and gold is just a bit of a correction. There's no reason why we shouldn't substantially increase in price here with gold and silver over the next few months, especially since our good friend Jim Cramer has come back on the scene as usual to be hyper bearish on gold. What is the Cramer effect? Pulsar, I bet you know. Brian Smith, I know you know. The fiat dollar is being replaced as reserve currency by gold, says Brian. That is a very good idea. It is very likely. Remember, Jim Cramer is the same person to tell you that Bear Stearns is a fortress, that Lehman Brothers is a buy right before they collapsed. So when this man is saying, I reiterate the selling of gold, Paul, as it has become a total speculative / meme Bitcoin replacement, trim, as in cut it, that should give you a big indication of what gold and silver is looking like for the future. Now let's look at BYND. This is BYND Meat, right? BYND stock, BYND stock ticker. I will expand this a little bit so you guys can get a better view here as well, and adjust it for you overall. This was today's stock ticker, in case you were not watching. It was a complete hot mess. A hot mess, ladies and gentlemen. This stock was a ride, a roller coaster today, which I know quite a few of us in the think tank in our Discord were trading to the long side and to the short side with both calls and puts as it changed throughout the day. And if you managed to play your cards right, there was some solid profit to be seen there. But BYND Meat today saw a huge 180% daily gain throughout the course of the day today. About 90% of that, 90% gains occurred in pre-market, and the rest of that 180% occurred during the day. But by mid-morning, that quickly turned around, and limit up, limit down halts were absolutely exploding. Definitely something that people should have been keeping an eye on if they weren't. You can take a look at the trading halt data. I do have it pulled up here. You can see this is the New York Stock Exchange trading halts for BYND, Beyond Stock. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 trading halts, and possibly even more earlier in the day. No, there was 13 or so trading halts on BYND today. And of course, we know that the Limit Up, Limit Down Chair Advisory Committee consists of people like BlackRock, Board of Directors, Hubert De Jesus, State Street's Kimberly Russell, Citadel's Joseph McCain, and Jane Street's Andrew Upward. The people that decide, is this something we should halt, are the same ones that are basically causing it to happen. So we have to ask ourselves here, is this a conflict of interest? I would say it obviously is a massive conflict of interest, but people that are in charge of the Securities Exchange Commission are allowing this to happen over and over again. And if you're really thinking that retail investors bought 2 billion shares of stock in Beyond Meat because that's what Reuters said, you should really think twice. BYND stock only has 69 million shares available. 69 million shares are in this float, ladies and gentlemen. So you should really think, if there's only 69 million available shares and 2 billion shares were traded today, how in the world did that happen? Folks, this is directly due to the fact that institutions own the majority of Beyond Meat. I'm going to fix this for you here. Taking a look at Beyond volume today, only 43% of the volume occurred off exchange. That means in dark pools. The other, 56-ish, 56.5% of trading occurred on lit markets, on lit exchanges. And that likely had a lot to do with the reason why the price of the stock went up in the morning and went down beginning mid-morning. What I'm trying to say is, when orders are routed to lit markets, it causes the price to go up. When orders are routed in dark pools, it creates a minimal change in the price in compared to routing them to lit markets. So everything going off exchange, this 958 million shares were processed in alternative trading systems, ATSs. Many of them are dark pools. And what this creates is a condition for manipulation. Between this, dark pool trading, and lit exchange trading, it creates, or I should say lit market trading, it creates an opportunity for these same firms, these same ones that are creating these limit up, limit down halts, to actually manipulate the prices by stacking orders. They can stack buy orders in dark pools to prevent the stock from going up further. They can stack sell orders on lit markets to increase the speed at which the price falls lower. At the same time, they can trade these orders and these shares amongst each other back and forth, often through committing something called wash sales. And wash sales are, one, illegal, but two, very hard to track. So these firms can easily do it by trading the same shares over and over between themselves in order to help bring the stock price down. This is also done with order spoofing, in which fake orders are placed, and then other orders are processed, and this original order was canceled. That is spoofing. There was never any intention for those orders to actually make any difference or actually, let's say, be processed. They just want to make a difference in the stock price artificially, and they're canceled before they're actually executed. That is the only way that you can have a float of 69 million shares trade over 2 billion shares in a single day. You see this number right here? 2,144,850,871 shares were traded today when only 69 million should exist. That gives you a clear indication of just how serious some of these issues that we're dealing with on the stock market are right now. And the big problem here is that there are people out there that are still pumping this stock. Is there a potential for BYND to go higher? Yes. Is it extremely likely, and should it be compared to stocks like Gamestop or AMC? Absolutely not. You see, the difference is key. AMC stock, as it's had its immense price movements in the past, was and still currently is arguably owned in majority by retail, as was confirmed by AMC CEO Adam Aron. Over 90% of all AMC shares, including ETFs, are owned by retail investors. 90% owned by retail. That means institutions only own 10%. And when retail owns that many, the only way for these firms to have a sufficient number of shares trade is to create synthetic shares. That is why, as you can see here, AMC's off-exchange volume, that means dark pool volume today, was 75.64%. This creates a situation in which synthetic shares can be created if the firms sell shares through their alternative trading systems, through their dark pools, and then fail to deliver. If they're not able to buy them back in the future, they become FTDs, or failures to deliver. But that is less costly and more dilutionary to the company, less costly to the market makers, more dilutionary to the company at 26.5 million share volume. That's obviously bad for retail shareholders. At the same time, you can compare it to a stock that's majority owned by institutions. And you can look at Cinemark, which is much more accurately priced than AMC. AMC is the largest theater company in the world, but Cinemark, being majority owned by institutions, Citadel being one of the largest, is traded only 42.5% off exchange versus AMC's 75 to 79%. And a much fewer number of shares as well, only 4 million shares traded. One would say, yeah, but the float sizes are different. Correct. The float sizes are different. AMC's got about 1 billion shares. Cinemark's got about 500 million. So in reality, it's not a huge difference. It's about 50% the number of available shares on the float. Meanwhile, a much smaller percentage of shares of Cinemark are being traded off exchange, and the stock is much more accurately priced to where its market capitalization should be in comparison to a stock that is not owned in majority by institutions like AMC stock, which is much more greatly suppressed at significantly higher volume today at 34.8 million shares traded today versus Cinemark's only 4 million shares. Again, 4 million shares traded for Cinemark at 42% off exchange versus 34.8 million shares traded of AMC at 75.6% off exchange. And GameStop is higher as well. Not quite as high as BYND. Not quite as high as AMC's, but it's still 56.88 off exchange dark pool volume. Right? See what Todd Earhart here is saying, the price of AMC is not the price of AMC. And that is something that is very true for heavily shorted equities. Beyond stock, it's possibility of having a GameStop-like movement, in my opinion, is not impossible, but much more unlikely. The short interest on Beyond stock is very high, but a lot of those shorts took out their positions when the stock price was higher than it currently is now as well. So that doesn't mean that it's over for Beyond. It just means that there's a massive amount of manipulation occurring with it. And shorts have not closed out their positions just yet. That means there is still the potential for significantly more volatility in Beyond. The problem is that this company performs in a very small niche. Billions of people like to watch movies and go to the movie theater. Billions of people like to play video games and trading card game and etc. Right? Only a small percentage of people are looking for fake meat alternatives, right? Vegetarians, vegans, that's pretty much it. So, for starters, Beyond as a company does not really have the potential of GameStop or AMC, even though its market cap has increased significantly today alone. But at one point, its market cap was around $1.9 billion at the height of its, run today, up over $9. And even still now, it was down. It ended up going from 180% gain throughout the day to being down negative 1% at the end of the day. And then in after hours is down another 9.7%. So definitely an incredible movement here when you look at the 5-day, considering it was at 66 cents on Friday, right? At $1 on Friday versus what you're seeing now running up to $7.50 and being back down to $2.50. For Beyond stock. But again, it really boils down to the situation that's occurring with it as a company as a whole. It's just got a very small niche and a very small number of actual retail shareholders that are holding long. Some people are buying stock in the company to trade it, but very few people are actually holding the company. And this kind of deals a lot with what we're seeing right now going on with banks and private loans. A lot of the private loans and private credit issues that we're seeing right now are at serious risk of causing long-term financial harm to the global financial system. Let me squeeze this a little here for you guys so you can see it better. But this is from Moody's, and a lot of you guys are well aware of what Moody's is, right? And if you're not, they are one of the ratings agencies. Moody's is one of the leading ratings agencies in the United States. And they're basically saying here that U.S. banks' private credit loan exposure is nearing $300 billion. And at the same time, you've got Bank of America stating that we've got a huge possibility of financial runs, of forced selling in the stock market. Because of that, Bank of America is warning of forced stock sell-offs if these credit problems continue. We're talking illiquid private lending, which could trigger a lot of losses in the S&P 500. So we're talking pensions, IRAs, ISAs, thrift savings plans, 401ks here. And they've been warning that the S&P 500 is facing the significant risks of forced selling due to the growing problems that we've seen in a very non-transparent private lending market. There are hidden vulnerabilities that could see problems and troubles in the private credit spillover into public stock markets. So you're probably wondering how will the S&P 500 be affected if this is private lending, right? A lot of large asset owners, like pension funds, have adopted a two-legged strategy, right? A multi-tiered strategy. They call it a barbell because it's heavy on both sides. And they're very heavy in highly liquid and low-cost investments like the S&P 500 on one side of the barbell. And then they have these highly illiquid but high rate of return private equity and private credit funds on the other. And this has been very popular when markets were stable. But as Bank of America is warning, there's a huge problem in the private lending market that could emerge here. And this is trillions and trillions of dollars in the private credit market that is facing the scrutiny now with the higher interest rates that we're seeing. And CEOs like those from Bank of America are warning of rising defaults and cockroaches in the private lending sector, right? Cockroaches scatter when you turn the lights on. And that's kind of what we're seeing here. The risk to the stock market and your 401k and your pension stems from a severe liquidity mismatch. And so investors here could face serious losses and need to raise cash from their S&P 500 holdings, from their SPY index funds and ETFs in order to maintain margin collateral, right? Because even Bank of America is saying this is not something that I'm just coming out with to try to instill fear in people, but this is something we've talked about for several years now, that this could trigger a wave of forced selling in the S&P 500 that would push the index down, not because of the fundamentals of the companies listed, even though we all know there's a huge bubble going on right now, a massive AI bubble, a massive real estate bubble, huge contagion event that is originating in this separate, illiquid private lending world, has the possibility to seriously impact cryptocurrencies, to seriously impact the S&P and people's private funds. So again, a lot of people are going to shrug this off and go, meh, probably nothing. And you very well could be right. But at the same time, this could trigger preemptive selling or delta hedging from funds that are concerned about this mismatch and these losses that could lead to some massive scrutiny over these large asset firms. Here's another article about the $2 trillion warning, the cracks that are starting to show in the leveraged loan market. Major defaults, says Kristen Shaughnessy here. Check this out. Let me move this over for you guys and you can see it a little bit better. So in this article, they're saying that there's early signs of stress showing that investors and financial experts are starting to worry that the major defaults and growing debt exposure are raising alarms about the potential risks for the broader economy and that they're not isolated. And again, they're hinting at potential systemic risks from these smaller subprime lenders. Bank of England is warning right now about some of these other firms like First Brands and Tricolor, and the fact that they signal deeper financial risks in the economy. And I bring this to you because this is something that's continuing to happen over and over again. And when Bank of America, the Bank of England, the central bank, talking about the collapse of private firms like Tricolor and First Brands, we could potentially be seeing the beginnings of a deflationary period, of a stagflationary period in our global economy. And Primalend is entering bankruptcy after defaulting on their bonds. They've had a month of negotiations with creditors. They've missed interest payments. They can't even pay the interest on their debt. And these people specifically cater to subprime borrowers. And in case you're unaware, right now, repossessions for vehicles, used and new autos, are at all-time highs. All-time highs. A lot of people are underemployed, are unemployed. And the first thing that they stop paying is not going to be their home. It's going to be their car, their second car, their wife's car, their husband's car. And they might just give one up and just keep one that's paid off and share it. But a lot of what PrimaLend finances are auto dealerships that are buy here, pay here, that are these low-income borrowers. And one of the things that starts to reflect greatly on this is the Federal Reserve repo. These are the repurchase agreements. Do not confuse this with reverse repo. We've talked about reverse repo a lot on this channel. And reverse repo is quantitative tightening. It's sucking money out of the financial system by the Federal Reserve, whereas repo is more the opposite. Repo is basically lending money to banks in exchange for their collateral because the banks don't have enough, right? They need more funds. They need more money. They need to maintain their margin collateral. And if you look at this line here, where the repo shot up from $0 to $55 billion, was the collapse of SVB Bank, Silicon Valley Bank. And believe it or not, those of you that may be new to this channel are unaware, but right here, we called it a week and a half before it actually happened with SVB Bank and with Bitfinex, the cryptocurrency exchange. So we knew that they were associated with FTX, but we were unaware that FTX was actually going to go insolvent too because they were lying on their books. And after the collapse of SVB Bank and Bitfinex, which we came with a huge "I told you so." Anybody who's here from 2023 in the chat, please go ahead and drop it in the chat and let me know if you guys remember this. But we called it. It was very clear as it was coming, literally a week and a half before it occurred. And some people managed to do very well, but most people lost big time. And what we saw there in 2023 was the collapse of FTX, Alameda Research, the crypto exchange scam known as FTX. For in case you guys are unaware, that is Sam Bankman-Fried, SBF, not to be confused with Silicon Valley Bank, SVB, who also collapsed because they had a ton of money in FTX as well. That was the last time that we saw the repo markets explode from $0 to $55 billion. And look at how exponentially fast that moved. This was a big, fast movement, and we're starting to see something very similar happen. Even though it's just at the beginning stages, I can tell you guys, this can go from $6 billion to $50 billion or even $100 billion within a day or two, like overnight, literally. So while I'm not ringing the alarm bells at this very second, we need to know that companies like First Brands, Tricolor, PrimaLend, these $2 trillion warning cracks, or $300 billion in private credit exposure from U.S. banks. Look at how much the growth has been in non-depository financial institutions. It didn't happen overnight, although it has happened exponentially faster. Look at what's gone on over the last few years. This growth has been tremendous. And these firms are competing with those very same banks. They have over $300 billion in loan outstanding to private credit participants. And the U.S. banks lending to these non-depository financial institutions is $1.2 trillion alone, and the private credit loans at $300 billion. Again, this is from Moody's, the rating firm. That's 10.5% of U.S. banks' total loans. And that's increased over the last 10 years. That has increased by 300%. 300%. So this is a massive risk that we're seeing in financial markets right now. And I don't think that people need to, again, panic, but it is something that you should be made aware of, because that's how we end up with situations like Lehman Brothers, like Bear Stearns, like 2008, like Blockbuster and Radio Shack and Toys R Us. And in case you forgot, Toys R Us is back, but they're no longer owned by the same company that they used to be. They're no longer owned by the company that brought you all the nostalgia and childhood memories. They're owned by the private equity hedge fund that bankrupted them and has since used that same nostalgia to profit by opening new stores, making money for themselves, and having robbed all previous equity holders and investors in Toys R Us before their bankruptcy. They picked it up for literal pennies on the dollar. And now they're opening 30 new locations across the U.S. this year. They're saying in order to meet holiday shopping demand. So this is a brand new article. This just came out. And this gives you an indication of the same thing that these firms were trying to do with companies like Gamestop, with companies like AMC. But they failed to do so, again, because retail investors own the majority of GameStop and AMC. But it's happened before, and it's going to happen again. And at some point, it could be a very, very serious systemic risk. So that doesn't mean that it's necessarily over at any point here either. But again, gold and silver right now, with a healthy pullback, from what I'm seeing, have a lot more potential to go in the coming weeks and months, especially as the S&P are facing increased, not risks. Well, yeah, risks is true, but potential downside is the word I really want to stress there. Potential downside. And as the economy gets weaker, as we see more repossessions in auto loans, it's again, we're at all-time highs for the United States in auto loan repossessions right now, and all-time high in credit that people have taken out, private credit, again, credit cards, etc., loans, private loans. Gold and silver are looking mighty, mighty tasty, especially for mutual funds that are getting scared of the fiat, that are not seeing sufficient returns in other forms with the issues that we're having in the bond yields right now. So I will give you guys the warning to keep an eye out for that. Beyond Meat does have some significant possible volatility involved. But I will state, when you got Jim Cramer bearish on gold, bearish on silver and precious metals, man, that gives me some real serious FOMO personally. This is not financial advice, and I'm not an advisor. But I do believe that I will be increasing my position in precious metals. Not just because of Jim Cramer, but because of all the other issues that we're seeing with this stagflation that we're currently living through at this very moment. Keep that in mind, folks. I wish you peace and wealth. Make sure you're properly hedged. Look into the miners. What's going on with Hycroft Mining Corporation? Check it out. Hycroft Mining Corporation right now, up another 3.68% today. 233% increase year to date, of which AMC Theaters and Eric Sprott both bought a significant portion a couple of years ago. Eric Sprott is the CEO of PSLV, Sprott Physical Silver Trust. And as a matter of fact, before I let you go, I will tell you guys and show you guys this briefly. SLV is paper silver, and it is much more easily manipulated thanks to that paper silver. But because institutions own the majority of SLV shares, very little of it is actually going off exchange and traded in dark pools. The majority of it is trading on lit exchanges. But PSLV, in contrast, which is the Sprott Physical Silver Trust, I almost guarantee you it's higher. Yep, look at that. Because more retail investors own PSLV, because PSLV has a smaller requirement for you to be able to actually turn your paper silver into physical silver, it is more heavily owned by retail investors. And that's why its off-exchange trading is at 53% versus SLV's 42%. And that's kind of a good indication there is when you look at these indicators, check out how much of it is actually owned by institutions and how much is owned by retail investors. And then try to see if you can find a correlation there between the amount of price suppression that's occurring, the short interest that's reported, because again, it's publicly reported by these firms, and the percentage of shares that are being traded on exchange versus off exchange. Keep that in mind. And if you want to see shares stay on exchanges, you should look into companies like Lit Exchange. As I've showed you guys before, when it comes to Lit Exchange, it's a lot easier to get proper price discovery when shares are actually being traded on exchange. Because here's yesterday's numbers for AMC. 79.9% of AMC was traded in dark pools yesterday. Almost 80%. How much more wild can it actually get? That should give you a bit of an indication there. I wrote this tweet yesterday, and I'll read this for you in case you're not looking at the screen. When 80% of AMC's trading happens in dark pools, retail orders never meet each other on lit markets like the New York Stock Exchange or the NASDAQ. Instead, they're internalized by market makers. Okay? They are hidden from public price discovery. And this means that retail buying pressure is buried. Your orders never influence the visible price. Synthetic liquidity is created. These hidden venues enable fake share creation through derivatives and internal fills that never hit the open market. So the true demand for these shares is diluted because only 20% of it is occurring in the lit markets. And the other 80%, you are getting IOUs, fake shares, in the form of ones and zeros in your accounts that later on the market makers will try to buy elsewhere. And if they don't, well, those become failures to deliver. So the price action you see does not equal actual market demand. And this manipulation thrives in dark pools. With most of this trading being hidden, market makers can control the flow, they can spoof sentiment, and they can suppress prices. And for 30 days straight, the dark pool volume of AMC averaged 64%, reaching 79% yesterday, 79.9, so 80%, 75.5% today. And that is not a real market, folks. It is manipulation that is designed to protect short positions and mute retail momentum. And when you have a situation where these firms have to go out and buy it, then you have some automated delta hedging, which is what you saw on BYND stock today. And then when you have the massive price suppression from the day, so that it could go from 180% gains to negative 1% by the end of the close, by the end of closing today on a company like BYND stock, it screams market manipulation because that is the way that these orders are being routed. Again, lit markets for lit investors only on Lit Exchange. Automated dark pool avoidance. Automated lit market routing. artificial intelligence and swarm intelligence to be able to help you make the best possible informed decision. And you can own equity in the company. This is the first time any upcoming stock and crypto brokerage in the world has ever given you this opportunity. Why? Because these firms would much rather partner with large hedge funds and get a lot of money. But then at the same time, those firms are beholden to a lot of those hedge funds. And you've seen it time and time again. Look at what happened when they had to remove the buy button because the market makers and the clearinghouses could not keep up with the buying of AMC and Gamestop, POS, SLV, and 50 other stocks that were made position close only in 2021. Look at what happened just a couple weeks ago with the crypto flash crash, thanks to companies like Binance and Coinbase. Look at what happened with FTX and Alameda Research. All of these firms were run by people that were former Citadel, former Jane Street, former Virtue. This is not inherently a bad thing. But when those people are coming from firms like that, like Brian Harrison of FTX, Sam Bankman-Fried, etc., of former Jane Street, it becomes hard for them to do the right thing. And the only way that we as retail are actually going to be able to do the right thing in financial markets and prevent market manipulation of our orders is to work together to ensure that we position ourselves with a company, with a brokerage that is going to prevent our orders from being manipulated by not letting these manipulators get their hands on them in the first place. Firms do not have to route to wholesalers. Nobody has to route to the dark pools. But these brokerages like Schwab and Robinhood and Webull and you name it, even Public, even though they claim not to, receives payments for order flow, or your order flow, like Apex Clearing, who routes them through dark pools and other alternative trading systems so that they can front run your trades, so that they can maximize their profits, and so they can minimize how much you actually make. The more money that you lose, more money that goes into their pockets. I'll leave you with that, folks. I wish you peace and wealth. Have a beautiful rest of your day. Cheers, my friends.